today, we're learning about job losses at Amazon. It feels like almost every day we're hearing about yet another tech company conducting these mass layoffs.
There is piecemeal evidence of an employment market under some pressure. Amazon today officially announcing it is cutting 14,000 jobs. UPS saying it slashed payrolls by 48,000 this year. They join names like Target, Meta, Starbucks, and more who've culled their workforces.
Hey, welcome back to the channel. And what I'm about to tell you isn't just another headline about layoffs. It's something much bigger, and it's quietly reshaping the American economy from the inside out. Over the past few weeks, the giants of corporate America have started cutting their own flesh. Amazon just slashed 14,000 management jobs, its biggest internal shakeup ever. UPS followed with 48,000 layoffs, saying it's all about efficiency. Target dropped nearly 2,000 senior roles, and Charter Communications let go of more than 1,000 people in one sweep.
In every part of our business, maybe we can do more with less. So this doesn't really bode well for job seekers.
No, definitely not. And again, I'm one of the people that think incorrectly, but I think the unemployment rate's going to move in a measurable fashion higher over the next couple quarters, and we will get data at some point.
All told, nearly 1 million jobs have disappeared in just 9 months, the worst labor contraction since the pandemic. But here's what no one's really saying out loud. This isn't just a wave of layoffs. It's a reset, a sign that America's biggest employers are rewriting the rules of survival. So the real question is, are we watching the birth of a more efficient economy or the start of something much darker, a silent unraveling that will hit every household before anyone sees it coming? Before we dive in, don't forget to hit that like button. A simple like helps push this video to more people who need to see it. And that's where the real story begins. Because these layoffs aren't happening in a vacuum. They're the symptom of something deeper, something structural. The American economy, once the world's most resilient machine, is now cutting its own lifelines. A mix of tariff wars, inflation pressure, and the rapid rise of AI has created what analysts are calling a cost spiral. Operating expenses are exploding, not because companies are reckless, but because the rules have changed. Trump's import tariffs on metals, components, and consumer goods have driven costs so high that even the giants can't keep pace. UPS admits that cargo volumes from China to the U.S. have dropped by 27% in the third quarter, a direct hit to its logistics revenue. Carter's, the children's clothing brand, cut 15% of its office workforce under the weight of new import duties. Even Amazon, the symbol of technological adaptation, confessed that while AI speeds up innovation, it's forcing them to streamline to survive. Every company is now caught in the same paradox. To stay profitable, they must shrink. To stay competitive, they must automate. Political pressure, logistics costs, and uncertain global demand have fused into one relentless squeeze, one that's testing just how much efficiency an economy can take before it starts breaking. Still with us? Hit that subscribe button so you don't miss what's next. But the numbers only tell half the story. The real cost is human. Behind every efficiency announcement lies a family pushed to the edge, a community quietly hollowed out. For many Americans, the warning didn't come from the news. It came from an early morning email that began, "Thank you for your contributions." In October alone, over 25,000 new layoffs were announced, not including the tens of thousands already gone at UPS. Long-term unemployment, now nearing 2 million people, has become a warning sign of deeper structural strain. And when job cuts become routine, confidence breaks. Economists warn that if this trend continues, consumer trust could collapse, triggering what they call a technical recession, where fear, not data, drives the slowdown. The middle class, once America's growth engine, is pulling back. Less spending means weaker GDP, lower tax revenues, and a feedback loop of caution spreading through every sector. What was once a proud workplace ideal, no hire, no fire, has turned into a harsher reality. Fire first, survive later. While the U.S. tightens its grip with tariffs and unpredictable policies, something very different is happening just north of the border. Canada, often seen as a quiet observer in global trade, is now positioning itself as the safe harbor for the capital fleeing America's storm. As American CEOs struggle to balance political pressure with rising costs, Ottawa has been quietly rewriting its playbook, introducing a framework of tax relief and production incentives designed to mirror and even outcompete U.S. subsidies. The goal isn't confrontation, it's attraction. Canada isn't fighting the exodus, it's preparing to receive it. The results are already visible. Honda Motor announced a $15 billion, about US $11 billion investment to build an electric vehicle and battery production chain in Ontario, a project backed by an additional $5 billion in federal and provincial support. Together, these moves are expected to create thousands of local jobs and cement Ontario as one of North America's key EV hubs. But it's not just about cars. Stable policy, abundant natural resources, and a clean energy grid are giving Canada a rare edge: reliability. In an age when certainty is worth more than any tax cut, Canada's consistency is becoming its biggest selling point. Logistics firms, retailers, and manufacturers from across the U.S. are now quietly running the numbers, asking a new question: what if the future of American production is Canadian? The fallout in the U.S. is ironically fueling growth just across the border. Every layoff, every tariff shock, and every policy reversal in Washington seems to send a ripple of opportunity northward. What began as a short-term response to market chaos is slowly becoming a long-term structural shift, a new balance of power within North America. When the U.S. tightens investment through higher tariffs, Canada opens the door with tax incentives and clean energy credits. It's a contrast in strategy: protectionism versus partnership. Projects like Honda's multi-billion-dollar EV complex in Ontario aren't just headlines. They're proof that stable policies can cut production costs by more than 20%, creating supply chains that are local, predictable, and profitable. Dozens of American firms are now reevaluating their operations, shifting manufacturing or logistics hubs to Canada in order to remain within the North American market while sidestepping political risk. The logic is simple: why gamble on volatility when stability is just one border away? In this emerging landscape, policy stability has replaced cheap labor or logistics fee as the ultimate competitive advantage. Canada, once the junior partner in the Continental Alliance, is increasingly playing the role of an economic shock absorber, softening the blows of American turbulence while quietly shaping the future of the post-NAFTA order. Behind this quiet migration of capital lies a deeper shift, one that's redrawing North America's industrial map. From Windsor to Vancouver, a new production corridor is emerging, built not on recovery but on reinvention. Canada is no longer just supplying parts to global value chains, it's reshaping its role within them. Investment is flooding into core sectors like EVs, clean energy, logistics, and advanced manufacturing. Ontario and Quebec have become the twin engines of this growth, drawing billions from automakers, battery makers, and tech firms. For every U.S. plant that pauses, Canada seems to break ground on another. At the policy level, Ottawa is pushing for industrial self-reliance, building and controlling more of the value chain at home. Programs like Buy Canadian have already created tens of thousands of jobs, softening the impact of U.S. layoffs. While Washington fights trade wars, Canada signs supply chain deals, not to compete but to stabilize. It's a strategy of quiet substitution. Instead of confronting the U.S., Canada quietly takes its place as the steady anchor in an uncertain global economy. And that brings us to a bigger question, not just for America, but for the world. What happens when the largest economy on Earth starts treating layoffs as a strategy for growth? If cutting jobs to save margins becomes the new normal, who bears the real cost? Workers, consumers, or the system itself? Governments everywhere are watching to see whether Canada can stay stable as it absorbs this post-American wave of investment. Because if protectionism spreads, if taxes as shields become standard, global labor markets could slip into another cycle of volatility driven by distrust, not demand. The gap between efficiency and humanity is widening, forcing every industrial democracy to ask, how far can productivity go before it breaks the social fabric? Canada may be winning the short game, attracting capital, jobs, and confidence, but the long game remains uncertain. So the question now is simple: is this truly a turning point or just a pause between two storms shaping North America's future? Thanks for sticking around. If you found this valuable, like and subscribe to support more content like this, because the next chapter of this shift is already unfolding, and you'll want to see where it leads next.